So imagine you're managing like nearly $1 trillion in global wealth.
Right.
You're guiding the artificial intelligence infrastructure for the world's newest banks.
Okay.
And on top of all that, you're insulating the entire global economy against, catastrophic property damage. You're moving these massive levers of global finance. And yet
Wall Street still slaps you with the label of a, quote, boring insurance broker.
Exactly. It's wild. Welcome to a special talk, Ticker's edition of the Deep Dive. We are looking under the hood of Marsh McLennan Companies today.
Ticker symbol MRSH.
Yeah, MRSH. And honestly, for anyone holding this stock or even just thinking about buying in, this Q2 2026 earnings call is, it's a masterclass in absorbing global shock.
It really is. It's the ultimate mismatch between public perception and actual operations.
Right.
When you strip away all the corporate speak, this transcript isn't just, a story about writing insurance policies. It's a live action stress test of a massive global entity that is navigating some really brutal cross currents.
Yeah, brutal is the word.
You've got this historic collapse in certain reinsurance pricing, massive internal investments in AI infrastructure, and just generally shifting macroeconomic realities.
And yet, they're still just churning out cash.
Exactly.
And that is exactly why we are diving into this specific transcript today. Our mission is pretty clear. We're hitting the data hard. We're stripping out the jargon, and we want to deliver a really actionable, opinionated bottom line for your portfolio.
Because look, reading an earnings transcript, it can feel a lot like staring at a highly complex dashboard on a commercial jet.
Oh, 100%. If you don't know what you're looking at, it's just like a bunch of flashing lights and numbers designed to confuse you.
Right. You need to know which dials actually matter so you don't crash the plane.
Yeah. So today we're focusing strictly on the speedometer, the fuel gauge, and the engine temperature of Marsh McLennan.
Let's do it.
So let's look straight at the speedometer first, right? The headline numbers.
Okay.
Consolidated revenue hit $7.4 billion for the second quarter.
Huge number.
Yeah, that's a 6% increase year over year. Adjusted earnings per share came in at $2.96, which is a really solid 9% jump from the previous year.
Right.
And they posted an adjusted operating margin of 29.3%. So operating income hitting $2.2 billion.
So those are the JAP numbers.
Right. The generally accepted accounting principle.
Exactly. The ones that hit the financial news tickers, the millisecond the press release drops. But they don't actually tell you how the engine is running.
How do you mean?
Well, the most critical data point in this entire section of the transcript is a metric that Wall Street completely obsesses over, which is underlying growth.
Okay, right.
So the company reported a 6% JAP revenue increase, like you said, but management specifically isolated their underlying growth at 5% for the quarter.
And that's a big deal.
Oh, crucially. That 5% is an acceleration from the 4% underlying growth they reported in the first quarter of 2026.
See, whenever I see a gap between reported revenue and underlying revenue, my immediate thought is a company is either hiding something or they're trying to take credit for something they didn't actually build.
Sure, it's a fair instinct.
So walk me through the mechanics of that 1% difference. Why should you, as an investor, care more about the 5% underlying figure than the 6% GAAP figure?
Because GAAP revenue includes a massive amount of noise, especially for a global giant like MRSH.
What kind of noise?
Underlying growth basically strips out two major distortions. First, foreign exchange rate fluctuations, and second, recent acquisitions or divestitures.
Oh, okay.
Think about it like analyzing a tech company's user growth, right?
Right.
If a social media platform claims their active users grew by 20% this year.
Sounds great on paper.
Exactly. But then you find out they simply bought a rival app and absorbed all of their existing users. That 20% isn't organic growth.
They just bought revenue.
Exactly. They bought the users.
Yeah.
It doesn't tell you if their core app is actually attracting more people.
Right. And the currency aspect plays into that heavily as well, right?
Hugely.
Because if Marsh McLennan is doing massive business in Europe and the euro suddenly strengthens against the dollar,
right,
their revenue looks higher on paper when they convert it back to US dollars for their quarterly report, even if they didn't sell a single extra policy.
Exactly. So underlying growth removes the currency lottery and it removes the acquisition sugar high.
Yeah,
it isolates the organic pulse of the business. It answers the really fundamental question: is the core existing machinery of this company actually generating more value today than it was a year ago.
So when management points to a 5% underlying growth rate, they're basically proving that the core business is accelerating on its own merits.
Correct.
But let's contextualize that 5% organic growth for a second.
All right.
Because I look at that number coupled with, 9% EPS growth, and I just see a mature, slow-moving giant.
You think it's sleepy?
Well, yeah. In a market where retail investors are completely obsessed with double-digit tech growth and, software as a service multiples, and exponential AI scaling 5% looks sleepy.
I hear that a lot.
So why should someone managing their own portfolio actually be impressed by these numbers?
It all comes down to the law of large numbers.
Okay, unpack that.
So if a nimble software startup with $10 million in revenue grows by 50%, they added $5 million in new business.
Right. Good for them.
Good for them, but that is a literal rounding error for Marsh McLennan. We are talking about a company operating at a $7.4 billion quarterly run rate.
Wow. Yeah, that's a different scale entirely.
Exactly. Generating 5% purely organic growth on a base that massive, it requires an immense influx of new cash flowing through the door. I always say moving a boulder takes a radically different amount of force than moving a pebble.
That's a great way to put it. And, it isn't just the size of the boulder either. It's the incline they're pushing it up.
Absolutely.
Because the transcript makes it very clear they didn't just sail into this growth. They fought for it against some really brutal macroeconomic winds.
They really did.
So to understand the resilience of that 5% underlying growth, we have to kind of pop the hood and look at the specific divisions driving the revenue.
Let's do it.
Which leads us straight to the one glaring red flag in this entire earnings call.
Guy Carpenter.
Yes, Guy Carpenter. So the company operates this massive division called Guy Carpenter, which is their reinsurance brokerage business. And Guy Carpenter actually saw its revenue decline by 2% to $664 million in the quarter.
Right. And the data behind that 2% drop is where this transcript gets fascinating.
Because they didn't try to sweep it under the rug, did they?
Not at all. Management didn't hide from it. They pointed directly to a highly specific headwind. They cited a 16% drop in what is called the property catastrophe rate online index.
And this wasn't just like a mild cyclical dip, right?
No, the transcript notes that this 16% plunge is the steepest year-over-year decline observed in that index in its 25-year history.
That's insane.
It is. And because property risk makes up roughly 50% of Guy Carpenter's global portfolio, this historic index drop acted as a massive gravitational drag on their revenue.
Okay, we really need to unpack the mechanics of this. Because property catastrophe rate online index is exactly the kind of Wall Street jargon that makes retail investors just completely tune out.
Fair enough. Let's ground it.
Right. So first, let's look at the basics of the mechanism. Guy Carpenter is a reinsurance broker.
Yes.
They aren't writing the primary policy for a homeowner in Florida, right? They are brokering the mega policies that protect the primary insurance companies from getting wiped out by a hurricane.
Precisely. So if a primary insurer takes on the risk for, say, 10,000 homes on the coast,
right,
a Category 5 storm could bankrupt them overnight.
Just wipe them out completely.
Exactly. So they have to offload a portion of that catastrophic risk to global reinsurers. Guy Carpenter basically sits in the middle, structuring those deals and taking a commission.
Okay, so when the transcript highlights a 16% drop in this catastrophe index, they're describing what the industry calls a soft market.
Yes, a soft market.
And what does that actually mean?
It occurs when there is a massive flood of capital available from reinsurers. When capital is abundant, the reinsurers have to compete with each other to win the business of the primary insurers.
Oh, I see.
And that competition drives the price of the reinsurance coverage down. It becomes radically cheaper for the primary insurers to buy that protection against hurricanes or earthquakes.
Okay, so it functions exactly like a real estate agent operating on commission during a housing crash.
That's a perfect analogy, yeah.
Like if you're an agent and housing prices in your zip code suddenly plummet by 16%,
right,
you take a massive pay cut on every single house you close. You might be working just as hard, making just as many phone calls, and closing just as many deals.
Yeah.
But because the underlying asset is cheaper, your commission check shrinks.
Guy Carpenter is the real estate agent in this scenario.
Wow. That's a tough spot to be in.
And the math on that commission squeeze is brutal. Management explicitly noted on the call that this pricing headwind had a roughly 6 percentage point negative impact on Guy Carpenter's underlying growth in the quarter.
6 percentage points. Just from the pricing drop?
Just from pricing. If pricing had just stayed flat, not even gone up, just remained neutral, Guy Carpenter would have posted really solid positive growth. That 16% drop is just a tremendous hurdle to overcome.
But this is where the transcript reveals the sort of operational hustle of the management team.
They definitely didn't just roll over.
Right. They didn't just throw their hands up, blame the macro environment, and accept a massive contraction. The underlying data shows they were fighting tooth and nail to offset that pricing drop.
You really see it in two critical metrics they highlighted.
Okay, what were they?
First, despite all the chaos in the pricing index, Guy Carpenter maintained client retention in the high 90s.
Wait, really? The high 90s?
Staggering, right. Almost none of their clients jumped ship to a competitor like Aon or WTW.
That's loyalty.
It's incredible execution. And second, they drove strong double-digit new business growth.
Wow.
So they were aggressively expanding their market share, bringing in entirely new clients just to generate enough new volume to offset the lower commission per deal.
They're essentially trying to outrun a falling knife by sheer volume.
Pretty much.
But there was another data point in this section that really caught my eye regarding how they're navigating the soft market.
The cat bonds.
Yes. The transcript noted that Guy Carpenter led 20 catastrophe bond issuances in the first half of the year, totaling $5 billion in limit. And management actually called this out as a record for the division.
Yeah, that was a huge moment on the call.
So what is the mechanism of a catastrophe bond? And why is Wall Street suddenly pouring $5 billion into them through Guy Carpenter?
Okay, so a catastrophe bond, or cat bond, is this brilliant financial mechanism for transferring risk completely outside of the traditional insurance ecosystem.
Outside of it? How?
Well, instead of buying traditional reinsurance from a massive corporate reinsurer like, say, Swiss Re or Munich Re,
Right.
the risk is packaged into a bond and sold directly to institutional investors on Wall Street.
Oh, wow. Like hedge funds.
Hedge funds, pension funds, mutual funds.
So instead of an insurance company holding the bag if a hurricane hits, a Wall Street hedge fund holds the bag.
Essentially, yes. The mechanics work like this. An investor buys the bond, right?
Okay.
The principal they pay is held in a highly secure collateral trust. It just sits there.
Safe and sound.
Right. Now, if a highly specific predefined catastrophe occurs, say, a named hurricane hits Miami and causes a certain threshold of industry-wide financial loss, the bond is, quote, triggered.
Meaning
the investors lose their principal and that money is released from the trust to pay the insurance claims.
Ouch. And if the hurricane never hits?
If the bond matures without the disaster happening, the investors get their entire principal back, plus a very attractive interest rate paid by the insurance company that sponsored the bond.
It is essentially high-stakes gambling on the weather.
It really is.
But why would a pension fund risk losing their entire principal just for a slightly higher yield? I mean, that sounds crazy for a pension fund.
It sounds crazy until you factor in the holy grail of modern portfolio theory, which is uncorrelated returns.
Uncorrelated returns.
Right. So if you manage a massive pension fund, your biggest fear is a systemic macroeconomic crash.
Right. Like a recession.
Yeah.
Or a spike in inflation.
Or a global banking crisis. Those events will crash your stock portfolio and your corporate bond portfolio simultaneously. There's nowhere to hide.
Everything goes down at once.
Exactly. But a hurricane hitting Florida or an earthquake in California that has absolutely zero correlation to the Federal Reserve's interest rate policy or, the quarterly earnings of Apple.
Right. The weather does not care about the stock market.
Exactly. So it provides true diversification. Even if the S&P 500 drops 20% in a year, the cat bond will still pay out its high yield as long as the wind doesn't blow too hard.
Oh, I see. So Wall Street is hungry for that uncorrelated yield.
Ravenous for it. And Guy Carpenter, acting as the middleman for $5 billion worth of these bonds, shows extreme agility.
Because when the traditional reinsurance market pricing gets distorted, they just pivot to where the institutional capital is flowing.
Exactly. They are finding alternative, highly complex solutions for their clients.
Man, so they are hustling. They have high 90s retention, double-digit new business, and record-breaking cat bond issuances.
They're doing everything right.
But even with all that operational excellence, gravity still won, right? Guy Carpenter's revenue was still down 2%.
Yeah, the pricing headwind was just too massive.
And yet, if we go back to the speedometer, the overall consolidated enterprise grew underlying revenue by 5%.
Right.
That math only works if another division of the company is absolutely strapping a rocket to the top line to offset the reinsurance drag.
And they did. They built this structural shield against the insurance cycle.
Which brings us to, honestly, the most fascinating dynamic in this entire transcript: extreme diversification.
It's the secret sauce of MRSH.
So Marsh McLennan operates two main segments. The first is risk and insurance services, which includes Guy Carpenter and their primary broker, Marsh.
Right.
But the second segment is consulting. And the consulting segment came to the absolute rescue this quarter.
Let's hit the numbers on this consulting shield because they're wild.
Yeah, lay them out.
So Marsh Management Consulting, which they refer to as MMC, grew by a massive 15% on a reported basis and 13% on an underlying organic basis, hitting $1 billion in revenue for the quarter.
$1 billion in a quarter, just in consulting.
Yes, and that 13% underlying growth, that's exactly the kind of tech-like acceleration we were talking about earlier.
Right.
Management specifically noted this was the fastest quarter of growth for MMC in over 2 years.
And it wasn't isolated, was it? Like, it wasn't just one lucky contract they landed.
Not at all. It was broad-based across Europe, Asia, and multiple critical industries like energy and telecommunications.
But MMC was only part of the shield, right? Because their other consulting arm, Mercer, which, historically focuses on human resources, health benefits, and investment consulting, Mercer grew 7% on a reported basis to $1.6 billion.
Right.
And the standout within Mercer was their wealth division, which grew by 8%.
And here's the data point that frankly stopped me in my tracks while reading this transcript.
The AUM number.
Yes. Mercer Wealth's assets under management, or AUM, hit $846 billion.
It's crazy.
That is a 26% year-over-year increase.
It's a staggering figure, like nearly $1 trillion in assets under management.
Right.
I have to pause here because this fundamentally breaks the mental model most people have of this company.
Oh, completely.
I mean, is Marsh McLennan an insurance broker, or are they one of the largest investment firms on the planet?
They're both.
Why does their wealth management arm control a pool of capital roughly the size of the GDP of Switzerland, and why is it growing at 26%?
This is exactly why retail investors misprice diversified giants. Most people hear the word insurance and their brain just turns off.
Right, they think of their auto policy.
Exactly. But Marsh McLennan is a diversified professional services behemoth. Mercer advises massive institutional pools of capital. We're talking corporate pension funds, university endowments, sovereign wealth funds.
Okay.
They advise them on exactly how to invest their money to meet their long-term liabilities.
But wait, there is a massive difference between giving advice and actually managing the money.
Very true.
Are they just consultants telling a pension fund what to buy, or are they pulling the trigger on the trades?
Well, historically, they were just consultants.
Okay.
But the massive growth to $846 billion is driven by a structural shift in the industry toward the OCIO model.
OCIO, Outsourced Chief Investment Officer.
You got it. Managing a complex multi-billion-dollar pension fund has become an absolute operational nightmare.
Why is that?
Due to regulatory scrutiny, the need for alternative investments like private equity, and just massive reporting requirements.
So it's just too complicated to run internally.
Exactly. So instead of just taking Mercer's advice and trying to execute it themselves, these funds are simply handing the keys over to Mercer.
Wow.
They're saying, you be our chief investment officer, you manage the assets directly.
And the revenue mechanics of that are entirely different than taking like a flat consulting fee.
Entirely different. When Mercer acts as the OCIO, they charge a fee based on a percentage of those total assets under management.
So if the assets grow, the fee grows.
Precisely. The 26% year-over-year increase to $846 billion is tied to two distinct drivers.
Okay, what's the first one?
First, they're aggressively winning new clients. That's the operational hustle.
Right, going out and selling.
Yep. Second, and honestly more importantly, they're riding the capital market performance.
Because when the broader stock market goes up, the value of the underlying assets they are managing automatically inflates.
Exactly. If the S&P 500 has a massive bull run, the value of that $846 billion pool goes up. And since Mercer's fee is a percentage of that pool, their revenue climbs automatically, without them having to lift a finger to win new business.
So they're essentially clipping a massive systemic coupon on the broader stock market's success.
That's a great way to put it.
That is a brilliant structural hedge against the insurance cycle.
It really is the ultimate ballast for the enterprise.
Because if a soft market hits Guy Carpenter and reinsurance commissions plummet, it often coincides with a period of abundant capital and booming stock markets.
Exactly. Which means Mercer's wealth management arm automatically picks up the slack.
Amazing. But the diversification narrative goes even deeper than consulting and wealth.
Oh yeah, we haven't even touched on Marsh Risk.
Right. Even within their primary insurance brokerage arm called Marsh Risk, they are finding immense growth in highly complex, non-traditional sectors.
Absolutely.
They reported 4% underlying growth in the U.S. and Canada, and management specifically called out what was driving that.
And it wasn't what you'd think.
No, it wasn't standard corporate property or workers' compensation policies. It was driven heavily by, quote, digital infrastructure.
Digital infrastructure, which is a sanitized corporate term for data centers.
Exactly, data centers.
Yeah.
Because the generative AI boom requires massive physical infrastructure.
Right.
Companies are building multi-billion-dollar data centers that require specialized cooling, massive energy draws, and highly complex supply chains.
Walk me through the mechanics of insuring a massive AI data center, because this isn't like insuring a warehouse against a fire, is it?
Oh, not at all.
Because management explicitly mentioned creating solutions for counterparty credit exposures related to these data centers. What does that actually mean?
Okay, so let's say a major hyperscaler like an Amazon or Microsoft commits to building a $3 billion AI data center.
Right. Massive project.
Massive. They need a guaranteed enormous supply of electricity, and often from renewable sources to meet their corporate climate pledges.
Right. They can't just plug it into the wall.
No. So they sign a 20-year power purchase agreement with, say, a local utility or a wind farm developer.
Okay. Makes sense.
But what happens if that local developer goes bankrupt halfway through construction? Or what if a key supplier of highly specialized AI server racks just defaults on their contract?
Oh, I see. The entire $3 billion project grinds to a halt.
Exactly. The financial exposure is systemic. So Marsh isn't just insuring the physical building against a tornado.
Right.
They are structuring complex credit insurance to protect the hyperscalers against the financial default of their critical counterparties.
Wow. That requires a level of underwriting sophistication that, frankly, a standard broker simply cannot provide.
Right. And on top of the digital infrastructure boom, the transcript also cited double-digit growth in transactional risk.
Which is insurance tied specifically to corporate mergers and acquisitions, correct?
Yes, specifically reps and warranties insurance.
Okay, how does that work?
When one massive corporation buys another, the seller makes a series of legal representations about the health of their business.
Like what?
Like that they don't have hidden tax liabilities or that their intellectual property is totally secure.
Right.
But what if the buyer discovers a massive hidden lawsuit after the deal closes?
That sounds like a nightmare.
It is. So transactional risk insurance covers that financial fallout, which allows the deal to close smoothly in the first place.
Oh, I hate it.
So if we pull back and look at the entire diversification shield,
Yeah, let's look at the big picture.
they are making money off the AI data center construction boom. They are monetizing corporate M&A activity, and they are managing nearly $1 trillion in assets, clipping coupons on the stock market.
Right.
All while fighting through historic insurance rate drops in their reinsurance division.
You can instantly see why just glancing at the 5% headline growth number doesn't do this company justice.
Not at all. It's wildly impressive. But speaking of the AI data center boom, Marsh McLennan isn't just ensuring the AI revolution for other companies.
No, they're not.
They are actively spending hundreds of millions of dollars to implement it internally.
And this is where the transcript pivots from managing current market conditions to really writing the long-term future of the enterprise.
Yeah.
Management dedicated a highly specific, very detailed portion of the call to their internal transformation initiative, which they named the Thrive program.
Thrive. Let's hit the financial data behind Thrive because the numbers are stark.
They are.
The company expects to incur $500 million in charges to generate $400 million in total savings.
Right.
And they plan to reinvest a portion of those savings back into growth initiatives, particularly brand expansion, sales capacity, and artificial intelligence.
It is so vital to understand how that math actually works on a corporate balance sheet.
Yeah, because spending $500 million to save $400 million sounds backward to anyone managing a household budget.
Exactly. It sounds like you're losing $100 million.
Right, so clarify the mechanics of this restructuring. Where's the friction here?
Okay, so the $500 million in charges are one-time hits. Yes, this is the painful friction of restructuring. It represents severance packages for redundant layers of middle management.
Sure.
The financial penalties of breaking long-term commercial real estate leases as they consolidate their office footprint, and the massive initial capital expenditure of implementing new enterprise software systems.
Okay, so you take that $500 million blow to the chin exactly once.
Exactly once. But the $400 million in savings isn't a one-time event.
Right.
The $400 million is an annual run rate savings.
Oh.
By reducing their headcount, shrinking their real estate footprint, and automating manual processes, they permanently lower the cost floor of running the business.
Got it.
So you spend the $500 million today, but you save $400 million in year one, another $400 million in year two, another $400 million in year three.
It structurally expands their profit margins indefinitely.
Exactly. It's the corporate equivalent of paying a contractor a massive upfront fee to install a state-of-the-art geothermal HVAC system in your house.
Right. The initial check hurts, but your monthly utility bill is slashed to near zero for the rest of your life.
Perfect analogy.
And a huge component of that new HVAC system for Marsh and McLennan is their deployment of artificial intelligence.
Yes.
The CEO laid out a highly specific roadmap of AI tools they are rolling out across the enterprise.
They did. And it is a roadmap that actually bypasses the theoretical hype and goes straight to operational utility.
Okay, let's break down the specific tools they named, starting with the Marsh Risk Companion.
Okay, so the Marsh Risk Companion is an AI-enabled client platform.
What exactly is it doing for the broker on the ground?
Well, rather than a broker manually pulling historical spreadsheets to figure out what kind of coverage a client needs.
Which takes forever, I'm sure.
Right. Instead of that, this analytics engine allows clients to interactively model their own risks.
Oh, wow.
They can dynamically benchmark their current insurance tower against industry peers, run stress tests on their supply chain, and determine their optimal risk appetite in real time.
That's a game changer.
It is. It moves the broker from a transactional salesperson to a strategic advisor fueled by instantaneous data.
Very cool. And then the transcript detailed a tool called Atlas.
Yes, Atlas. Atlas is purpose-built for the Guy Carpenter reinsurance side.
Which, as we discussed, really needs the help right now.
Exactly. We talked about how complex and volatile that market is right now with the 16% index drop.
Yeah.
So Atlas is an AI platform that curates and expedites massive data sets regarding hazard scores, litigation risk, and real-time market pricing capacity.
So it's crunching all that data for them.
Yeah, it allows the reinsurance team to design complex risk transfer strategies like those catastrophe bonds we talked about, vastly faster and with a much higher degree of statistical confidence.
Makes sense. But the tool that really caught my eye was Claims IQ.
Ah, Claims IQ.
Yeah, the transcript noted they have already rolled this out to 3,000 claim professionals globally.
Claims IQ is the clearest example of AI driving margin expansion on this call.
How so?
Well, the insurance claims process is historically a labor-intensive manual nightmare.
Oh, I believe it.
It's all paperwork, cross-referencing policy language, and subjective evaluation. It's incredibly slow.
Right.
So Claims IQ ingests the anonymized data from millions of historical claims that Marsh has processed over decades.
Okay.
When a new, highly complex claim is filed, the AI instantly recognizes patterns from those millions of past claims.
So it knows what's happened before.
Exactly. It compares the specific loss data against the intricate policy wording and delivers automated insights on the most efficient way to manage the life cycle of that claim.
To maximize the outcome for the client.
Right, while minimizing internal labor hours for Marsh.
It is essentially institutional memory on demand.
That is exactly what it is.
But, the most interesting AI play wasn't internal software, in my opinion. It was a division called Quotient.
Oh, yes. Quotient isn't a software tool at all. It is a specialized team within their consulting segment.
Right.
This is where Marsh McLennan goes from using AI to actively selling AI advice.
Okay, unpack that.
Quotient is an AI strategic advisory group.
So they are charging clients to tell them how to use AI.
Exactly. Management explicitly noted that Quotient was a huge driver of their 15% consulting growth this quarter.
That's wild.
They gave a fascinating example on the call. Quotient helped clients launch several entirely new AI-native banks around the world.
AI native banks. What does that even mean?
These aren't traditional banks bolting on a chatbot to their website.
Right.
They are financial institutions built from the ground up on generative AI infrastructure.
Wow.
And Marsh McLennan is architecting the risk frameworks for these entities. They are monetizing their own expertise in how to safely deploy these models in highly regulated environments.
Okay, I have to step in here and challenge the narrative we are building.
Go for it.
Because every single Fortune 500 CEO is playing buzzword bingo with the term AI on earnings calls right now.
Oh, absolutely.
It is the easiest, most transparent way to get Wall Street algorithms to bid up your stock price. It's practically a reflex at this point. And more importantly, an analyst on the call explicitly challenged the CEO on the fundamental economics of this AI rollout.
He did.
The analyst asked about rising token costs. They wanted to know if the massive cloud computing costs required to run these frontier AI models would simply eat up all the labor efficiency gains they are projecting.
Right.
So I have to ask, is this Thrive program just a shiny object to distract investors, or is the unit economics actually viable?
That is the most critical question asked on the entire call.
Yeah.
Because the analyst who brought up token costs understands the dark secret of the current AI boom.
Yeah.
Inference is incredibly expensive.
Explain inference for the listener.
Every time an employee asks a large language model a question, it requires massive computing power, which the cloud providers bill in units called tokens.
Okay. And if you have 90,000 employees globally, all running queries through an expensive frontier model like OpenAI's GPT-4 every single minute of the workday,
Yep.
your Amazon Web Services or Microsoft Azure bill is going to absolutely skyrocket.
To the moon.
It could easily wipe out the $400 million in structural savings they promised.
Precisely. But the CEO's response to that specific question is what separates Marsh McLennan from the companies that are just playing buzzword bingo.
Okay, what did he say?
He didn't offer a vague platitude about future efficiencies. He pointed to a highly specific proprietary internal tool they built called LendWork.
What is LendWork, and how does it solve the token cost crisis?
LendWork is what the industry calls an agentic assistant.
Okay.
And crucially, the CEO was incredibly transparent here. He openly admitted that LendWork is a couple of months behind the absolute frontier models in terms of raw generalized capability.
Right, so it's not GPT-4.
No, it isn't going to write a symphony or solve novel physics equations. But they built it in-house, fine-tuning open source models specifically for their internal corporate ecosystem.
I see.
And because it is highly specialized and smaller in parameter size, it is vastly cheaper to run.
So they are doing a form of cost arbitrage on compute.
Exactly. LendWork handles the overwhelming majority of everyday lower complexity tasks.
Like what?
Like helping colleagues draft initial sales strategies, summarizing internal documents, or doing the first pass on responding to a request for proposal.
The busy work?
The busy work. It does this at a fraction of the token cost of pinging a massive frontier model.
That's smart.
They have engineered a tiered system. They rely on their cheap internal LendWork model for 90% of the daily workflow.
Right.
And they only pay the massive token costs for third-party frontier models when a highly complex specialized task at Mercer or Oliver Wyman explicitly requires that level of reasoning.
Oh, I love that. It's like managing a corporate fleet.
Yeah.
You give your sales team reliable, highly efficient Honda Civics for their daily commute.
Right.
And you only rent the Ferrari when you actually need to drive on a racetrack.
Exactly. You exert total control over the operational costs while still extracting the utility.
It is brilliant unit economics.
It really is. And they are pairing that cost control with a massive structural partnership.
With who?
They announced an alliance between Oliver Wyman, their management consulting arm, their internal operations team, and Amazon Web Services.
AWS.
Yes. They're working directly with AWS to completely re-engineer their mid and back office processes.
Which processes are they targeting first?
The initial focus is on the most manual, friction-heavy parts of the business, specifically claims services and the issuance of reinsurance treaties.
Ah, the paperwork.
Exactly. They're not just using AI to write better emails. They are utilizing AWS's infrastructure to structurally automate the deeply unglamorous, highly expensive plumbing of the global insurance industry.
Wow. If they successfully execute this overhaul without letting token costs spiral out of control, the margin expansion we see in 2027 and beyond could be tremendous.
Oh, absolutely massive.
So we have dissected the historical context, the brutal 16% reinsurance drag, the consulting shield that offset it, and this massive unit economic aware AI infrastructure play.
It's a lot.
It is. Which brings us to the third crucial pillar of this transcript, management guidance. What is the executive team actually promising the street for the back half of 2026?
The overarching tone of the guidance was highly confident, but carefully measured.
Measure of how?
They stated plainly that they expect 2026 to be a, quote, good year.
Very safe wording.
Very safe. Projecting that underlying revenue growth will continue to track similarly to the solid levels generated in 2025.
Okay.
Furthermore, they committed to delivering another full year of margin expansion and solid adjusted EPS growth.
But earnings calls aren't just for broad strokes, right? There had to be some highly specific, nuanced data points for the financial modelers out there.
Oh, definitely. Let's look at the quarter-to-quarter dynamics.
Okay.
For the analysts building out their spreadsheets, the CFO provided a crucial caveat regarding the cadence of their profitability.
What was it?
He explicitly noted that margin expansion will be materially stronger in the fourth quarter than in the upcoming third quarter.
Why the discrepancy between Q3 and Q4?
It is largely driven by the timing of their internal investments, things like the Thrive program implementation costs and the historical seasonality of their revenue recognition.
Got it.
Additionally, he tempered expectations slightly regarding that massive 15% consulting growth we just discussed.
So it's not going to stay at 15%?
No. He guided that MMC's underlying growth will likely normalize and slow down to the mid-high single digits in Q3, coming off that exceptional 13% high watermark in Q2.
Okay, that makes sense. You can't run that hot forever. And there was another highly specific macro-driven headwind mentioned in the guidance related to a line item called fiduciary interest income.
Yes.
We really need to explore the mechanics of this because it is one of the most fascinating hidden profit centers of a global brokerage.
It really is.
What exactly is fiduciary interest income and why is management guiding that it is going to drop?
Okay, fiduciary interest income is the ultimate structural advantage of the broker business model. When a massive corporate client buys a $50 million insurance policy, they pay that premium directly to Marsh McLennan.
Right.
Marsh acts as the intermediary. They hold that cash in trust before eventually passing it on to the actual insurance carriers.
But they don't pass it on immediately.
No, there is a time lag.
Yeah.
And because Marsh McLennan processes tens of billions of dollars in premiums globally,
Right.
they constantly have a massive rolling pool of cash sitting in their fiduciary bank accounts at any given moment.
This is essentially the concept of float that Warren Buffett used to build the Berkshire Hathaway empire through Geico, right?
Exactly.
Using other people's money to generate yield while you hold it.
Precisely. It is free capital. While that massive pool of cash sits in their accounts waiting to be remitted to the carriers, Marsh McLennan earns interest on it.
And that's pure profit.
Pure profit. It drops straight to the bottom line with virtually zero cost of goods sold.
Amazing. So why is it becoming a headwind?
Because the amount of money they generate on that float is entirely dictated by the macro monetary policy of central banks.
Oh, I see.
The yield on that cash is tied directly to prevailing interest rates.
Right.
And because the Federal Reserve and other global central banks have been actively cutting interest rates to manage the broader economy.
The yield Marsh can earn on those bank deposits is dropping.
Exactly.
Let's hit the specific numbers on that drop.
So in Q2, their fiduciary interest income dropped by $11 million year over year, landing at $88 million.
Okay.
And the CFO guided that it will drop further to approximately $95 million in Q3, which, crucially, is lower than the comparable quarter last year.
Wow. So it is a pure macro headwind that is entirely out of the management team's control.
Completely out of their hands.
They could be executing flawlessly, but if the Fed cuts rates, their fiduciary income shrinks.
Right.
Which actually makes the fact that they still generated 9% overall EPS growth even more staggering.
It really does.
Think about it. They absorbed the reinsurance price collapse, they absorbed the interest rate cuts eating into their float, and they still grew earnings by 9%.
It speaks to the power of that diversified model. And that sheer cash-generating power leads directly to perhaps the most actionable data point in the entire transcript.
The capital deployment target.
Yes. Despite the macroeconomic headwinds and the massive internal AI investments we just talked about, management actually increased their 2026 capital deployment target.
This is where the rubber meets the road for the retail investor, honestly.
Well, definitely.
They bumped their target up from $5 billion to $5.5 billion. Let's break down the mechanics of capital deployment.
Okay.
When a company generates this much free cash flow, they essentially have three primary levers to pull to benefit their shareholders.
Right.
They can pay out cash dividends, they can buy back their own stock on the open market, or they can deploy that cash to acquire other companies.
And increasing that target by $500 million mid-year is a massive signaling mechanism.
It's a huge flex.
It really is. When an analyst explicitly asked why they felt comfortable increasing the capital deployment target, given, all the global uncertainty,
Right.
the CFO's answer was incredibly telling. He stated that they entered the year with a degree of caution, but halfway through, their operational results are tracking perfectly, they have excess cash building up on the balance sheet, and they simply have, quote, more conviction about their forward outlook.
More conviction. That's exactly what you want to hear. And they aren't just making promises, they are already putting that capital to work aggressively.
They are.
The transcript notes they spent $1.5 billion on share repurchases in the first half of the year alone.
And share repurchases are a highly efficient way to return value.
How so, for those who might not know?
By buying their own stock on the open market and retiring those shares, they reduce the total outstanding supply of stock.
Right.
So if the overall value of the company stays the same, but there are fewer slices of the pie, every remaining share you hold in your portfolio instantly becomes more valuable.
It fundamentally engineers higher earnings per share.
Exactly.
And for the yield-focused investors, they didn't ignore the dividend either.
No, they didn't.
They announced a 10% bump to their quarterly dividend. That marks the 17th consecutive year of dividend increases for Marsh and McLennan.
17 years.
That's a long time.
I mean, that covers the 2008 financial crisis, the 2020 pandemic, massive inflationary spikes, and multiple hard and soft insurance cycles.
It really proves that their free cash flow generation is largely insulated from systemic macro shocks.
It absolutely does.
So we have unpacked the historical context of the numbers. We have examined the brutal headwinds in the reinsurance market. We have scrutinized the unit economics of their AI investments.
Yep.
And we have the forward guidance and capital allocation strategy on the table. It is time to synthesize this data and deliver the verdict.
The bottom line.
The bottom line. Based on the totality of this transcript, is this a bullish or a bearish signal for the stock?
Synthesizing everything we've analyzed, from the micro mechanics of their AI rollout to the macro mechanics of their capital deployment, this earnings call presents a fundamentally and aggressively bullish signal for Marsh & McLennan.
I look at the data and I come to the exact same conclusion. But let's build the explicit case for the listener. What are the core structural pillars of this bullish stance?
Okay, it rests on three undeniable realities demonstrated in this quarter.
What's reason number one?
Reason number one, the extreme diversification model undeniably works under pressure.
Right.
We just watched their property catastrophe reinsurance business, which is a core historical pillar of their identity, take a historic 25-year record 16% pricing hit in the index.
If they were a pure play reinsurance broker, their stock would have been decimated by that single data point.
No, completely. They would have been completely at the mercy of the soft market cycle.
Right.
But Marsh & McLennan absorbed that massive blow to the chest, and they still generated 5% underlying revenue growth and 9% EPS growth.
Because of the shield.
Exactly. Their MMC consulting arm, their Mercer Wealth Management division operating as an OCIO, and their expansion into digital infrastructure risk perfectly insulated the bottom line. It proves the structural integrity of the entire enterprise.
Okay, what's reason number two?
Reason number two is their highly pragmatic, unit economic focus execution of artificial intelligence.
Because we went into this transcript pretty skeptical of the buzzword bingo, honestly.
We did, but they passed the operational test.
Mm-hmm.
They aren't just buying off-the-shelf software, eating massive token costs and hoping for theoretical efficiencies.
Right.
They are actively monetizing AI strategy through their Quotient Consulting Group. They are building proprietary cost-effective models like Lenwork, specifically to mitigate the cloud computing costs that are currently crushing the margins of less disciplined companies.
It's very disciplined.
Very. And they are executing a structural partnership with AWS to fundamentally re-engineer the back-office plumbing of the industry. It is a very real, very math-driven margin expansion story.
And the third reason?
The third reason is the sheer undeniable gravity of their shareholder yield.
Right.
Look at the macro environment. You have deep geopolitical uncertainty, a softening global insurance market, and central banks cutting rates, which eats directly into their fiduciary float.
Yeah.
In the face of all those headwinds, the management team's response is to increase their capital deployment target to $5.5 billion, spend $1.5 billion on buybacks, and raise the dividend for the 17th consecutive year.
That is the behavior of a management team that knows their cash flow generation is practically bulletproof.
It really is.
So what does this actually mean for you, the listener, managing your own capital?
Yeah, let's bring it home.
It means that MRSH is functioning as an all-weather stock. If you are looking at a choppy macroeconomic environment and want to build a defensive moat in your portfolio, this provides stability, a growing dividend yield, and insulation from market shocks. But simultaneously, because of their massive consulting arm, their deep integration into the multi-billion-dollar AI data center build-out, and their proprietary internal automation, it offers legitimate offensive upside.
Which is rare.
It is an incredibly rare combination of defensive yield and offensive structural growth.
It is exactly the kind of stock that rarely makes the flashy front page headlines, but quietly and relentlessly compounds wealth over decades.
Right.
However, as we wrap up this analysis, there is a broader, almost philosophical industry question that this transcript raises, and it's something I think every long-term investor in the financial services sector needs to ponder.
Ooh, okay. What is the underlying question?
So toward the end of the call, management discussed the rollout of a tool called Coverage Intelligence. This is an AI platform designed to give their frontline brokers the ability to automatically ingest complex risk data, instantly identify hidden gaps in a client's coverage, and analyze and compare highly complex quotes from multiple carriers right at the point of sale.
It effectively gives the broker superhuman analytical speed.
It does. It makes the human broker vastly more efficient.
Right.
But if you play that tape forward, it begs a long-term existential question for the industry.
Which is?
If an AI platform can eventually automatically synthesize millions of data points, perfectly optimize a risk portfolio, and instantly find the absolute best insurance policy at the most efficient price, what happens to the traditional human insurance broker?
Oh, wow. That is the ultimate disruption narrative. Does the highly sophisticated tool built to assist the broker eventually become so competent that it replaces the broker entirely?
Exactly. Will the relentless advancement of AI eventually commoditize the very advice and intermediation that Marsh McLennan currently sells for billions of dollars?
That's a scary thought for them.
Or, conversely, will the sheer escalating complexity of emerging global risks, things like underwriting the counterparty credit risk of a $5 billion renewable-powered AI data center, or navigating the geopolitical fallout of a shattered global supply chain, make the nuanced, strategic human interpretation of that AI data more valuable than it has ever been? Will the machines simply do the high-speed math, but leave the high-stakes, boardroom-level strategy to the humans?
That is the multi-billion-dollar question. And how Marsh McLennan navigates that exact balance between automation and human expertise over the next 5 years will absolutely determine if they remain the king of the hill or if they get outmaneuvered by a tech-native disruptor.
It's going to be fascinating to watch.
It really brings us right back to that commercial jet dashboard analogy we started with. We have checked the dials today. The speedometer is showing 5% organic growth. The fuel tank is overflowing with $5.5 billion in capital deployment. And the engine temperature is running cool despite the massive reinsurance headwinds.
Right.
But the airspace ahead is changing rapidly, and the plane is increasingly starting to fly itself.
Very true.
Thank you for joining this Talk Tickers edition of The Deep Dive. Remember, the true story of a company is rarely found in the neat, sanitized bullet points of a press release headline. You have to keep looking past the jargon, pop the hood, and stare straight at the underlying mechanics. Until next time.